Welcome to the Teaching Tax Flow Partnership Basics mini lesson. And we're going to talk about the partnership business entity type today and how a partnership is really similar to a sole proprietorship, except there's more than one proprietor. So let's jump into our agenda. We're going to talk about the formation, the management, and the asset protection for a partnership. We're going to talk taxation, reporting, and if fringe benefits are available. We're going to dive into IRS guidance, and then, of course, we're going to have our teaching tax flow calls to action. So, partnerships. I did mention they're similar to sole proprietorships in many ways, in so fact that you're not required to file formation documents with the state filing agencies. So, partnerships are much more informal from a state filing perspective, meaning filing with whatever state you're doing business in, formally, such as articles of organization or articles of incorporation. Owners of a partnership are called partners. LLC owners are called members. Sole proprietors or someone self-employed is called a sole proprietor. But a partner owner is a partner, or a ownership of a partnership is simply a partner. Partnerships have partnership agreements, and that outlines the management, including ownership percentages and the share of profit and loss. It's real easy to contribute property to a partnership, and it's usually a tax-free event. So if two partners have real estate or an asset and they want to put it into a partnership, there's not a tax event for the person contributing that asset. Partnerships simply dissolve with the death or bankruptcy. So death of a partner or the bankruptcy of the partnership, it would simply dissolve the partnership if that happens. It's really good for owners that have a synergy and want to avoid double taxation, similar to a C corporation. But partners are typically liable for the debts of the business, so it does not come with an asset protection that a limited liability company comes with. All right, let's take a look at that taxation. At the partnership level, from a federal tax perspective, there's no tax paid. Income and losses are simply passed through on a Form K-1. We're going to take a look at that in a little bit. A partnership files an annual federal partnership return, which is called a Form 1065. As I mentioned, that K-1 form, the K-1 is a partnership equivalent to a W-2, and each partner gets a K-1 from the partnership, and that's used to file a tax return and report on a personal tax return. Double entry bookkeeping is required because the tax return requires a balance sheet. We're going to look at that in a moment. It really gets partnerships are somewhat complicated because you have to keep track of each partner's basis and each partner's capital account. So complex books and records are needed. Partners are eligible for some fringe or for some excludable fringe benefits and taxable benefits are reported as guaranteed payments on that K-1 and adjust the Schedule K-1. So we're going to look at that K-1 in a moment. Partnerships generally have to use the same tax year as the partners. Net income and guaranteed payments are subject to self-employment tax. So assuming you have a business, and we're not talking about rental property, typically the net income and guaranteed payments are subject to self-employment tax, but the qualified business income deduction or the 199A deduction, that 20% deduction is available to partners. That's all reported on that K-1. Let's take a look at that 1065 form. This is the tax form, the federal tax form that a partnership will file. It's due March 15th of every year. You can get an easy 6-month extension. And make sure that you file that because the penalties for not filing this partnership return are significant. This is the first page, and then this is page 5, but I wanted to put that on there because it outlines the balance sheet and how you have to really break down these equity accounts for the partners. Partnership taxation is a major part of the tax law. We highly recommend you work with a tax professional that's very familiar with Publication 541, which you're looking at right now. Finally, as far as forms, let's look at that K-1 form. This is going to be issued to each partner in a partnership. It's going to state the partner's name, address, social security number, or could be a federal ID number. This area right here tracks the capital account, and then this area here tracks several different items like share of income, share of self-employment income, share of rental income, and a bunch of QBI deduction information. A lot of information in this one, so let's hit our calls to action. If you have a business or you're looking to start one, take a look at that entity type chart as part of the Teaching Tax Law Entrepreneur course and determine if a partnership fits your needs. Review your partnership agreement to make sure that those Schedule K-1s are prepared properly. So I greatly encourage anyone that's in a partnership to have a formal partnership agreement. LLCs call it an operating agreement, but for a partnership, it's a partnership agreement. That agreement dictates the share of profit, share of losses, share of deductions, and how to allocate that on a tax return. If you're concerned about asset protection, you might want to consider forming an LLC instead of being a partnership, because that does provide asset protection. As you know, in many of these mini lessons, we are not attorneys, so definitely consult your legal advisor on that. If you form an LLC, so if you go from a partnership to an LLC and you're concerned about really paying a lot in that self-employment tax, consider making that S-Corp election. Finally, multi-member LLCs with real property very, very rarely benefit from making any type of S-Corp election. I want to put that disclaimer out there. All right, thanks for watching this mini lesson. Have a great rest of the day.
John here from Teaching Tax Law. I wanted to thank you for watching this video. We literally have hundreds of hours of content between podcasts, webinars, videos just like this built specifically for you, the taxpayer. Whether you're a full-time employee, you're a freelancer, you're a contractor in some other sense, or you're thinking about getting into business for yourself, everything here at Teaching Tax Flow is perfect for you, basically going off of the roadmap provided by the IRS to legally and ethically reduce the taxes paid over your lifetime. So be sure to subscribe to this channel and connect with Teaching Tax Flow, and we will see everybody very soon.